Taxes and Income, Lesson 3, How Taxes Affect Your Paycheck. In this lesson, you're going to learn about the difference between gross pay and net pay, as well as all of the deductions that are taken from your paycheck before you even get paid. By the end of this lesson, you'll have a better understanding of why you don't take home every dollar you earn and where that money goes. Payday is exciting. Everybody loves payday. But it can also be disappointing when you realize how much money that you don't keep because the government takes it before you ever get it. When you get paid, it'll either be deposited directly into your bank account because you had signed up for direct deposit, or you'll get a physical paper paycheck. Either way, you're going to get a pay stub that contains a lot of important information on it. It's going to tell you how much money that you earned overall, how much you paid towards taxes and benefits, and how much is left over that you get to take home. Not all paychecks are like this because different financial situations affect our take-home pay. So let's break those down. Gross pay versus net pay. The first thing that you need to understand is that gross pay and net pay are not the same thing. Gross pay is the total amount that you earned before any taxes or benefits are deducted. Net pay, often referred to as take-home pay, is the amount that's left over after everything is deducted. To remember the difference, think about it as if someone has captured a part of your money with a net, because it's kind of true. Federal deductions are what the federal government takes out of your paycheck. Those deductions are federal income tax, Social Security tax, and Medicare tax. The federal income tax is usually the largest deduction that's taken out of your paycheck. When you get hired at a job, one of the first things that you do is fill out a W-4 form, which tells the government how much money to take out of your paycheck to cover your taxes. If you don't know what a W-4 form is or don't really understand them, don't worry. We're going to go over those in detail about W-4s later in this module. If the federal government takes out too much money, then you'll get a refund when you file your taxes the following year. However, if they don't take out enough money, you could end up owing money when you file your taxes. And nobody likes owing the government more money. The federal government also deducts money from your paycheck for Social Security and Medicare programs. You're required to help fund these programs by paying a percentage of your income, which is currently 6.2% for Social Security and 1.45% for Medicare. Social Security and Medicare are supposed to help with your income and insurance needs when you retire. So as long as these programs are still around in your 60s, you're going to have a little bit of help. On top of paying federal income tax, the state that you live in may or may not have their own tax that you're required to pay. Your state income tax gets deducted from your paycheck to cover any state taxes you could owe the following year when you file your taxes. There are 9 states that don't require you to pay the additional income taxes on your wages. Those states are Alaska, Florida, Nevada, South Dakota, Texas, Washington, Wyoming, Tennessee, and New Hampshire. The other 41 states either have a flat income tax, which is where everyone pays the same amount of tax regardless of their income, or a graded income tax, which is where the amount of taxes owed increases as your income increases. Depending on what state you live in, you might also have to pay a state disability insurance tax, known as the SDI tax. This provides short-term financial aid to employees who can't work due to non-work-related physical or mental disabilities. An example of this would be breaking your leg while you're snowboarding, resulting in you being unable to stand on your feet and work. In most states, the SDI workers receive 50 to 80% of their regular wages while using state disability insurance. Only 5 states require you to pay into this tax, including California, Hawaii, New Jersey, New York, and Rhode Island. In all the other states, if you want this disability insurance, you're going to have to purchase it on your own. The money collected from state unemployment insurance taxes is used for the payment of unemployment insurance benefits. Unemployment benefits help provide financial aid to those people who meet the requirements set by their state. Typically, you have to be unemployed due to factors outside of your control, such as being laid off. Each state sets their own rules for eligibility and benefit amounts. In most states, the employer is responsible for paying these taxes, and they are not deducted from your paycheck. The exemption to this rule is if you work in Alaska, New Jersey, or Pennsylvania. Employees in these states are subject to state unemployment insurance tax withholdings. Local income tax is a type of tax that some local governments impose on people who live or work in a specific area, such as a city or a county. Only states with state income tax can establish local income taxes. But living and working in a state that has income tax doesn't necessarily mean that they also have a local income tax. There are only 17 states that have both state income taxes and local income taxes. If your employer offers an insurance plan and you sign up for it, your payments might be deducted from your paycheck to cover your medical, dental, or life insurance premiums. These deductions are voluntary. If you don't enroll for any of these types of insurances, then you don't have to pay for them. If your employer offers a 401k or another type of retirement plan and you sign up for it, you get to choose a percentage of your paycheck that you want to have taken out for retirement. This is another voluntary deduction. Whether or not you invest in your retirement is your choice. We're going to go more into depth on investments for retirement in another module. Other types of deductions are court-ordered wage garnishments, child support, and alimony. You learned about these deductions in the debt module. Depending on the state that you live in, courts can allow up to 50 to 65% of your wages to be garnished for child support and alimony. These types of deductions, like income tax, Social Security, and Medicare taxes, are not voluntary, and they will be deducted from your paycheck if you owe them. You just learned where all of your hard-earned money goes before you get what's left over. The more that you pay in taxes, the less money that you have to live on, which is why it's so important to have the correct amount of money withheld from your paycheck.